So now we'll begin our discussion in terms of capital markets and monetary policy. And you have the bios. So we're just going to go straight ahead to the presentations. Ray, you want to start us off, please?
Okay, I can start. So I don't know if you have the opportunity. Sorry. Yes. Okay. I don't know if you have the opportunity to see my presentation or not. Okay. So okay.
You can see the monitor over there.
Okay. Yes. Thank you. So what I want to do, I do not want to propose, I will say, an articulated view or articulated expectation about capital market. I want just to address a few questions, just to feed the question and answer we can have in a second time. I will discuss shortly real economy, shortly monetary policy, and maybe also a little bit elements of valuation on markets. So if I switch to real economy, I think the first question is about what have you to expect concerning US growth. I remember very well, and I think we all remember very well, how optimistic the Fed has been in the past. And so I think we have to take the current optimism with a pinch of salt. On this chart, two things. First, I will say if you contemplate business surveys, you have the impression of growth stability expected for the next quarters, about 2.5%. So not the 3% growth expected some time ago, but on the other side you can see what we can say a nowcast. It is nowcast as calculated by the Atlanta Fed, and at least for Q1 you see it is lower and lower. I think the last figure is 0.3%, so 2.5, 0.3 for this quarter, and what else for the future? I think it is not that clear. Same thing I will say about Europe. So my question is, what will be the style of the recovery in Europe? I think you have to make a distinction between two possibilities. I will say the usual cyclical recovery style. You must have it on the left side. So I will say it is in relation with all the business cycle story we know well. But if we admit the idea that we are in exceptional time, why not thinking about the plugging model? Plugging model is a reference to a research made by Friedman. I will say it was in the 60s. The idea is simply, you come back to the trend, but you have no ability, I will say, to overpass the trend, so to catch up from the previous losses. I think it is an interesting question, and partially you have an answer. It is on the northeast of the slide. It is the answer by Bruegel, and the answer by Bruegel is simply to say maybe we are more close to the plugging model than to the, I will say, usual type of a recovery. So we'll see in the future, but I think math is not said for the moment. Let's switch to inflation, and let's start with the US. We contemplate this slowdown in unemployment rate, and there is a satisfaction for that. What does it mean for wage growth? Do we see some acceleration in wage growth? For the moment, no. Will it come? Maybe. For which reason? For the moment, it is not that clear. And in any case, look at the chart on the right. This is not about future. It is only about history. The ability of the US economy to reach the 2% target in the recent time, even before the collapse in oil price, this ability simply was not obvious. So for which reason we will come back soon to the 2% target? Maybe, I don't know, but once again, an interesting question to develop. If we come back to Europe, I will say, if we believe in some type of improvement in growth, I think, yes, we can consider that risk of deflation is low. It is what I try to explain with this chart, related growth to inflation expectation. But I think that the main question, once again, is what about the possibility coming back to the 2% target in not too distant future? Acceleration in inflation? Sure, I will say. Coming back to 2%, I don't know. Once again, there will be a debate. I switch to monetary policy, and I start with the US. So, and I contemplate real interest rates since a few decades. It is where we are. So you see, from one decade to the following one, the trend is clearly downward. So today, real Fed funds rate are in the negative territory. So what will be the new reference for the new decade? I will say not the current level. Do we come back to the level we recorded during the first decade of the century? Maybe, but I will say I see difficulty coming back to the higher levels we recorded in the past. And second question about the US, usual one today on the market, the difficult dialogue about Fed fund rate expectation between monetary policy makers and the market. Will the two series converge in the next future? So I think that today, after the last FOMC meeting, the convergence has just begun, but I think for the moment all of that stays timid. Other question about monetary policy. So it is only about the divergence between Fed and ECB. What does it mean for market? So I will say FX market, obviously. Volatility in other markets, for sure, but it is uncomfortable. Maybe we have I will say 6 months of a more quiet time with the last FOMC meeting, but it will be only 6 months. I refer to first hike only in September. So if I switch to market and valuation, I like this chart. It is simply a comparison between growth in value, so volume plus price, and 5 years interest rates. Relation was quite close in the past. This relation has blown up, I will say, with the Great Recession. So, will we find a new relation in the future? So the question, if we have to make an assumption for the future, what have we to consider as the target rate for, I will say, 5 years or 10 years govies, whatever in Europe or in the US? Frankly, it is a question mark. We don't know. Last but not least, as we say in English, so return with a comparison, a very usual comparison, equity versus bond. It is very likely in favor of equity, but I think it is opening a new debate because low return of bond. I think we have to accept the idea that we enter in a period of overvalued asset prices. It will be uncomfortable for sure. And so what will be the magnitude of the overvaluation markets will accept in the future? Once again, we don't know. John, I stop here.
Thank you very much. Malik, your turn.
So Thank you. Thank you for the invitation to this conference. I will make some remarks on the environment and specifically on monetary policy. When we look at the global environment in developed countries, we realize that we are in a sub-growth period. You know, growth in the US, growth in UK are not that strong. There is still, as it was mentioned before, there is still a lot of slacks in the labor market in the US. There is a problem of productivity in UK. Japan is in recession, and the euro area is not having a strong growth momentum currently. Maybe it will come better in the future, but for the moment it's still weak. And so that's the first part. The second part of the analysis is to say, in all these countries, inflation rate is close to zero. And even if you take the core inflation rate, it's not that strong. None of them is above or close to the target, the central bank's target. So it's another issue. And the last point is that in all these countries, interest rates are at zero. Central banks' interest rates are at zero. So it means that low growth, no inflation, and zero interest rate for central banks. Clearly, we're not out of the crisis. So that's the main point. And that's how we have to understand how Janet Yellen last week has developed her strategy at the FOMC. It's too early to change her position because there's still no inflation in the US. Even if you look at the Fed forecast, there is no inflation expected in the coming 2 years. You know, next year it will be just below the Fed's target. So in that environment, how can we expect that the Fed could change our strategy? And that's what Janet Yellen said. She said, we will try to maximize employment, but we have to converge to a trajectory that will go to 2%. But she said at the same time, we have no pressure on wages, we have no pressure due to oil price, we have no pressure due to a strong dollar. But so how can we expect that inflation rate will converge to a 2% target this year or even at the end of the year? So probably nothing will be done by the Fed this year. That's our position. We don't think that the Fed will change its monetary policy in 2015. And so we have there is a lot of discussion. There was a question during the Q&A session at the press conference saying, well, maybe it would be useful due to delay in monetary policy, it could be useful to act preemptively. Okay, but who in this room know exactly when inflation rate will accelerate in the US? Because if there is delay, we have to act preemptively. But we have to know at what moment the inflation rate will increase rapidly. Nobody knows that. And we know that since the last 5-6 years, you know, even in 2008, 2009, there was what Paul Krugman had called the very serious people who said, well, with non-orthodox monetary policy, we will have very strong inflation rate very rapidly. It's not the case. Central bankers are revising their target, their forecast almost at every session. So there is a real issue here to say, well, in that environment, how can we expect changing monetary policy now if we know that we don't know exactly when inflation rate will increase? We have some anecdote on this issue in the past. We all have in mind what has happened in 37, 38 in the US, when the Treasury and the Fed tried to normalize their monetary and fiscal policy. And it was a failure in 38, so they have to change back their monetary policy. More recently, Ben Bernanke in May 2013 said, well, things are going better now, we will normalize our monetary policy. We saw what has happened on the mortgage market later in the year. So, and I think that with this experience, we still have to wait until we have some real inflation pressure to before seeing the Fed changing its monetary policy. That's an important issue, and for me the main reason for the absence of inflation pressure come from slacks in the labor market. Catherine Mann mentioned the employment rate. That's clearly the case in the US. And more than that, when you look at the people between 25 and 55 years of age, their employment rate is still 2% below the average employment rate seen in the previous business cycle. So we are not in a situation where we can imagine having strong pressure on wages and so strong pressures on prices. So that's an issue. And so the question we have to ask after that is to say, well, if we don't expect inflation rate, what will happen? Probably we will have to keep monetary policy on a very accommodative mode. Probably we will have to keep interest rate at zero more in a longer time period than what was expected. That's the issue. That's to say, in that case, we will have to manage liquidity more than interest rates. And so, in that case, what are the questions? If we don't have strong pressure on inflation, probably it weighs on the way that we don't have strong growth. But anyway, it's a new kind of question. And so there is two questions here. The first is to say, in this environment, with zero interest rates from central banks, what will happen on financial stability? That's a real issue. How will we be able to manage the situation? We currently have this question every day from traders, from journalists, from everyone in the bank, saying, well, what will happen on financial stability if we keep interest rates as low as they are now? So probably it means that we will have to increase regulation on financial markets just to avoid a kind of bubble. The other point is to say, well, if inflation rate is at zero, close to zero, below central bank's target, if interest rates are close to zero, probably we will have a real issue on resource allocation. Because we know that with high inflation rate, we have a lot of volatility in prices. That's what shows the data from the beginning of the 80s. We can imagine that having a very low inflation rate, we will have very low volatility in the relative prices. And so it means that it will be a drag to resource allocation. And zero interest rates is just a way to say intertemporal allocation will not work correctly, doesn't work correctly. So how to manage this situation? Probably it will reintroduce, we will have to reintroduce, excuse me, a more efficient fiscal policy. That's the issue. If we have no inflation rate, we will have to have a stronger fiscal policy to change the rules, to change the situation, to create another situation for growth prospects, for inflation prospects. It doesn't say that we will need to have a kind of stronger Keynesian economics as we, with a large type of expenditures. No, we have to have a very targeted expenditure just to increase productivity, because that's the issue. That's what was mentioned this morning and before us by Catherine. It was just to say, well, what about investment? Is there a role, and probably I think there is a strong role for public investment in that environment, just to create incentive, just to create a change in people's mind. The last point I wanted to mention is about the euro area, because we have had a real change in the euro zone situation, because since last spring we are now in a demand-oriented monetary policy, and that changed the picture. We will have a stronger growth, a stronger situation. And what I just want to mention, I don't want to develop all the issue, but I think that the three step from the ECB is a real good idea, from lower interest rates for long, the TLTRO to make the ECB a real lender of last resort, and the QE, just to say, every exchange rate, interest rates will stay low for a very long time period. So we will change our mind in the euro area, and it means that we will have more degree of freedom, from and I think that's the main difference between the US and Europe. In the US in 2009, the situation, I remember some paper from Christina Roma saying we have to let the environment adjust. We don't have to constrain it too much to avoid what was seen in the 30s. So the rebalancing of household situation has been important in following the evolution of the US situation. In Europe, we have been constrained from 2011. We all had austerity policies, and now things are changing a little bit. Austerity policy is not as strong as it was in maybe 2 or 3 years ago, and now we have a strong monetary policy, and it means that we will have more degree of freedom when we are a company, when we want to export. We will have more, and more than that, we are helped by the low oil price, and it means that for household, it's good for their purchasing power. So everyone can now choose. They have a way to choose their and make their own arbitrage. But what I wanted to say is that we will have impulse from everywhere, from in France from exports, in Spain from exports, in Italy, etc., in Germany, and as it was mentioned by Catherine Mann, we will have, as we know, we have a strong, deep and dense trade, intra-trade in the euro area. All this impulse will make the business cycle in Europe more consistent. That's what we saw in the 80s, that's what we saw in the 90s, that's what we saw before the crisis, and it was a situation where 1 plus 1 was more than 2. But since 2011, we have a very volatile business cycle in Europe. We don't have consistency between the business cycle in different countries in Europe, but probably with what is doing by the European Central Bank, with a lower euro now, we will have a more consistent business cycle. And I think that in 2015, 2016 and 2017, the part of the world where we could have good surprise on the economic prospect could be the Eurozone. Thank you.
And Daniel?
I just want to show you a few charts and to share with you long-term charts to try to understand where we are at the moment and to try to understand if not, we can talk about post-crisis era. So if you look at this chart, you see that, in fact, the Fed intervention was clearly a success. Otherwise, probably we would have been into deflation like in the 30s. So we avoided the 30s style deflation, which is a very good thing for the Western economies. Now, turning to equities, if you look at the S&P over a very long period, you can see that you have some period of bumpy market, stabilization of the market, then bull market. And in 2008, we arrived at a point where everyone was talking about the Great Recession and comparing this Great Recession with the Great Depression of the 30s. And the very positive thing is that thanks to Fed intervention, we really avoided a long bear market. This bear market lasted only 6 months. That's for the positive news. However, there is a negative news, which is what's next, and that's what we're talking about since the beginning of this day. So, as many people talked this morning, the Fed will change its policy, and the question is, will it or will it not impact equity markets and the whole economy? That's something we have to discuss. But what we could say for sure is, first, volatility is much lower than during the last century. So in any case, we are expecting volatility to surge in the coming quarters, or if we say it differently, the day the Fed hikes its rates, then volatility will come back to normal, probably in the range of 17 to 20 times. That's the first point. The second point is, I believe we are not in a post-crisis era just because the level of debt in developed countries is still very high. If you look at the blue line, debt to GDP is much higher than in the previous decades. That is to say, something has to be done to have a kind of normalization of this situation. So now what I'd like to do is to focus on where we are, and if necessary, I will come back to this chart. So I believe we are in the center of a long-term crisis. US crisis is almost over. Rates are going up in the coming quarters. I think in 2015, we will end the Eurozone crisis for two reasons. The first reason is what happened the 22nd of January this year, that is to say, the ECB decided to launch, finally, its full QE. The second reason I believe we will see the end of this crisis is because, in a way or another, we will decide with the Greeks whether Greece will stay in the Eurozone or if we manage to put the Greece out of the Eurozone. So for those two reasons, I think the financial crisis will be over, but once again, the overall crisis is not over. Because there is a third part of this crisis, which is the emerging market crisis and commodity crisis. For those who know me, I present this chart for a long time, and I believe that the day the US dollar go up and up and up, it began already, then it will hurt a lot emerging economies. So why US rates are up, everyone talked about that. It's because in theory, according to the Taylor rule, rates should be in the range to 2 to 3% and no, not close to 0. What will happen is that on one hand, the Fed and the Bank of England will decrease the size of their balance sheet even in the coming years. And on the other hand, the ECB and the Bank of Japan will increase their balance sheet. So it's a kind of desynchronization of economic policy and of monetary policies, of course. And already what we could see is negative yields in many European countries for the 2 years, for the 5 years. And we know also that the day the ECB began to increase rates, 9th of March this year, then they will buy a lot of government bonds, and rates in those countries will stay very, very low. I remind you that bond at the moment for the 10-year yield is below 0.2%. That's the inadequacy that Catherine mentioned just before this session. Positive thing, very positive thing, we can see it with the green shoots, and it's the blue line for the Eurozone. You see that for Europe, economic surprises are going up and up and up, whereas in the US, it's going down. So if you look back 5 years or 10 years, it's the first time we see that such a difference between those two economies, and it's probably linked to the fact that the euro is very weak at the moment, and to the fact that ECB is in action, and also to the fact that the oil price is very low, and we have an halt in credit contraction in some European countries. So basically, as some of the other speakers talked about, many countries in Europe eased their monetary policy. That is to say, as a conclusion, and that will be my first conclusion, the US dollar is on a rising trend, up and up and up. And the euro, as a foreign exchange reserve currency, is down. That's the left-hand chart. So this chart for me is the first conclusion, even though last week, thanks to the speech of Mrs. Yellen, the rise of the dollar stopped for a while, for a few days. I think the trend will continue in the coming quarters. The second conclusion I want to address today is that all these policies favor risky assets. And on the left hand, if you compare 2007 price of equities in terms of price to book and in terms of PE, you can say in orange you see what happened in 2007 and in blue in 2015. You can say that basically in terms of price to book, Europe is still very cheap. But in terms of PE, it's expensive. What does it mean? It really means that we need to have an increase in EPS in European corporates to see the equity European market surge further. I remind you that what you have experienced in Europe since the beginning of this year, that is to say roughly plus 20% in terms of equity indices, is almost nothing if you look in terms of dollar. In terms of dollar, the DAX, the CAC, etc., rise only by 5%. So just before the conclusion, I will address few risks I see in this market. The first risk is geopolitical tensions with Greece, of course, but we can talk about Ukraine, Russia. The second risk is basically what could happen with the Fed when they will increase their rates. And the last question mark is regarding China. China, as many people mentioned already, is decelerating, and it could have an impact on markets. So to summarize, you could see this chart trying to explain Eurozone and China. You have a little bit of rain. It's not perfect, but Central banks are here to save this zone. On the other way around, you see that the US, everything is great, sunshine, but be careful. You need some sunglasses, otherwise you could be hurt, and so you have to be careful. And the major conclusion we have is euro will continue to fall. We're expecting parity to the dollar in 1 year time. US rates will remain probably very low for the long-term yields, 10-year yields, just because you have a lot of money which wants to be invested in the US, so looking for safe haven US assets. And the major question mark we have now is the valuation of the S&P, maybe a little bit too high, and can the US corporate still deliver with a strong US dollar? That's a question mark. They will have to maintain very good results to have a further rise in the S&P. Thank you.
Okay, so my first question to Hervé, you had a chart up there about equity returns and bond returns. What happens to the traditional equity risk premium?
I was saying to John, it is a good question. I don't know if there is a clear answer to this good question. I think that in the next future, we should have a decline in the risk premium, and so it will be a way to inflate a little bit more the equity markets. I think that my main point on this issue is, I will say, the rationale versus the constraints. Rationale, it is what I have explained. We can discuss extensively the level of overvaluation for this asset or this other asset, but we can start obviously with bonds. And the second point is about constraint. Constraint, just to tell a long story short, we have a serious balance sheet mismatch for investors. And so chase for return is definitely open. And so I think that whatever the rationale, we will look for a return. There is no way to exit. So yes, it means that the management of market risk will be a serious issue. So it will be a job for central bankers. This is something they will have to address. But I will say, if I go one step further, because I think that we have low rates because still excess of debt, and because of low rates, we have this mismatch between the asset side and the liability side of balance sheet. I think the only way to resolve the issue will be to promote more saving. But if we do that, we understand very well what it means. I will say at least in the first step about growth. So I think if we go beyond short term and if we contemplate the medium term, it can fit because more saving will imply more investment. Fine, it is a way to resolve the issue, but short term, I don't know. I think we are in a kind of dead end, and so this is not comfortable.
So Philippe, I'm glad you opened Pandora's box. So here's my problem. You mentioned about increased regulation on financial markets to avoid bubbles. All right, so I've got basically a whole bunch of central banks out there, and your argument is that they really can't raise interest rates. But I also have stock markets hitting new highs. So my question to you is, okay, I see more and more subprime lending in autos. I see more subprime lendings for homes. I see the stock market hitting new highs. To what extent does macro-prudential regulation start to come in and do what the interest rate formerly did in global economies?
Well, before the 2007 crisis, interest rates was not at zero, were not at zero, and we had the US had subprime and all these non-working real estate market. So the question is, will higher interest rates change the situation? I'm not sure. Probably it's a question of regulation. Probably it's a way to think differently of the way the lending market is working. Okay, you can increase interest rates, but we know that during the subprime period, you could have for the first 2 years very low interest rates, etc. So the question clearly is not linked to interest rates. It's mainly a question of regulation, and the Federal Reserve has probably to work on it, just to avoid this kind of mismatch we've seen in the past. So for me, that's the issue. The point is that what will happen if we have higher interest rates? What would be the level of interest rates that would avoid financial instability? Probably, I don't know, 3-4%?
But so it looks like the transmission channel isn't through interest rates anymore or bank lending. It's really macro-prudential regulation. That's how we're going to regulate or look at the financial markets. That's an interesting change.
We have to go this way, and because interest rates is not working as it used to, and so the point is that we have to think differently the situation. We have to realize that okay, monetary policy have helped avoiding the situations that could mimic what we've seen in the 30s. But anyway, the current dynamics of the world economy is not strong at this moment, and even with zero interest rates. So if we clearly have to boost demand, that's why I mentioned fiscal policy, and I think that for central banks there is three issues. We know that they have targets and employment, etc. But I think that there are three issues. One is on economic activity, one is on wealth, specifically on real estate wealth, and the third is on financial markets. And I think that I've not demonstrated that, but my guess is that these three angles of the triangle are not consistent one with each other. Maybe two are consistent one with each other, but not the three. And for the moment, I think that the best thing to do is to promote growth and promote household wealth through real estate, and to change the picture to avoid financial instability. We have to increase regulation on financial markets.
One final question from me, and I'll open it up. Dan, you raised an interesting point. Some of us have seen the Euro stock index go up for the last 2 or 3 years. But from a U.S. investor perspective, sitting in Southern California, if my dollar is going up, the euro's going down, I look at that position and I say, wow, I really can't be buying European equities because I'm getting killed on the currency, especially if we're going to go to parity.
Yes, you're completely right, John. That's an issue because now we are waiting for corporates to deliver in terms of earnings. So far, if you look at what happened in 2012, 13, and 14, earnings revisions were downward compared to the US corporates. So in Europe, we had many downward revisions. Having said that, if you look at a full, what I call a food-fed cycle, that is to say, June 2004 until now, that is to say when the Fed increased rates in June 2004, then decreased rates, and then is on the way to think of increasing rates again, you see that European stocks didn't perform so bad. If you exclude, in fact, two sectors, it performed quite well. Which are those sectors? Technological sector, just because the new leaders, Google, Facebook, etc., you don't find any of them in Europe. And the second sector, which performed much better in the US than in Europe, is the oil sector, thanks to shale oil, shale gas, where you had a lot of corporates in the US which did quite well. Exclude those two sectors, and in terms of performance, Europe was okay. So it's a long view of European markets, not just 2 or 3 years.
So we got time for 2 questions. Paul, of course. Paul used to work at Smith Barney.
I have a very simple question, and that
His
is
questions will be quite demanding.
much too long on cash in dollars and euros. I'd like to hear from each of you, what should I do with that cash?
You spend it. You know, we need to increase demand, so you have to spend it. It could be nice. That's my answer.
My answer will be you purchase Europe stocks, but you hedge the currency risk. Today, this is not that expensive.
My answer would be to invest in southern European countries still, that is to say Italy, Spain and Portugal, where I think you could have some good news in the coming quarters, but you need to be patient. It will take a while until you see the result of these investments.
Following again on Philippe's suggestion, after the session's finished this afternoon, Paul will be treating everyone to wine. Kathleen, last question, don't break.
Thank you. Kathleen Stephenson, AIG. Nobody has... It's a question for the panel. It's a question for the panel.
That's okay, Kathleen, I can hear. Go ahead, I'll repeat it if you don't.
Just a comment about Greece and the potential contagion effect or none. If there is a serious issue with the outcome.
So, again, Kathleen's focus is on Greece, potential contagion effect or not, and then with the implications in terms of negotiations. Anyone want to take that one?
Okay.
Okay.
I can start. On Greece, this week is very important. You know, Alexis Tsipras has written a letter, and so it's a very important week for Greece, for Europe. I think there is two answers to your question. One is coming from Mario Draghi when he spoke in London on July the 26th in 2012, when he said Europe is a political construction. Euro is just an instrument. We have responsibility as central bankers, but what is important is the political construction. If Greece exits from the Eurozone, it will have to exit from the European Union, and so it will not belong anymore to the political environment for Europe. That's really problematic, as we know the importance of Greece in the European construction, not this year, but in the past. So that's first part of my answer. The second part is that a lot of you are coming from the US. What will be your point of view from, I would say, a non-European view from Europe? The question is, who's next? And who's next? And then, if I'm an American investor, an Asian investor, I would say, well, wait and see. I don't want to to go now to Europe, I don't know what will happen. We don't know exactly what will happen, but we all fear that it creates heterogeneity inside the Eurozone, and in a way it could create a kind of premium on specific countries, probably not on Germany, but maybe on Portugal, on Spain, maybe on France. And in that case, the homogeneity the Eurozone is expected to be will no longer exist. So it could create a very weak situation, and that's probably why the way the Greek play the game, saying they will not go so far to push us out of the Eurozone to avoid this maybe this type of contagion. But we saw yesterday or the day before that the politician, the German government and Angela Merkel and other European government were stronger than that. So it's this week will be very interesting in this issue, but it can be dramatic if it doesn't work correctly.
Hervé, couple minutes.
Yes, if I have to go for a provocative answer, I think that you have to listen carefully to what NATO is saying on the issue. I think what NATO doesn't want is that an exit from the Eurozone will be the first step to quit the West. We know today the type of special connection through the Orthodox Church between Russia and Greece. And clearly, I think it is our common interest today to keep as solidly as possible Greece within the West. Yes, it means some effort by both camps, Greece and the European partners, but both camps will do the efforts.
Daniel?
Just a very quick answer. If you're asking this question to markets, there is an index called Euro Breakup, which is telling you now that 30% of investors are thinking someday something could happen with the euro and Greece in particular. Second point, if you look at all the Eurozone countries since the beginning of the crisis in 2009, there is one country where the rates went up sharply and still are very high, which is Greece. And there is also one country and one unique country where the equity market is still down minus 50% since 2009, which is Greece. So Greece, it's a key question. I don't think you will see some contagion if Greece get out. I just say, as I said in my presentation, we will have the answer quite shortly this year, whether we will continue with or without Greece. But this question must be solved by the end of this year.
So thank you all, panel, and we're on to our break.